projected global output contraction was revised downwards as many countries had to extend the lockdown period in the wake of a second wave of coronavirus infections and continued lack of effective treatment or vaccines for the novel coronavirus disease. However, there is cautious optimism that the global growth contraction would reverse to positive growth path by 2021 as the pandemic is contained, potential treatment found, and restrictions on business activities are lifted by most economies. The committee reviewed developments in the global and domestic economic environment in the first half of 2020 and evaluated the monetary policy options to address these challenges. 10 members of the committee were in attendance. The global economic developments. Global output growth weakened further as a result of the persistent headwinds from COVID-19 pandemic. These headwinds comprised persisting decline in global aggregate demand and supply, disruptions in global supply chain and trade, rising sovereign and corporate debts, heightened financial market vulnerabilities, low prices of crude oil and other commodities, and rising unemployment. The committee noted with concern the IMF's further downgrade of global economic contraction to minus 4.9% from minus 3% in 2020. The downward revision was based primarily on the amplified negative impact of COVID-19 pandemic on many advanced and emerging market economies as they witnessed extended lockdown periods and restrictions on economic activities. Committee noted the general optimism of a V-shaped global growth trajectory due to the expected early abatement of the pandemic and the gradual resumption of economic activities. However, the committee believes that global recovery, while assured for 2021, is more likely to be a U-shaped one. In this regard, it is not surprising that the recovery has been revised downwards from 5.8% to 5.4% in 2021. Committee observed the continued downward trend in inflation in most advanced economies, particularly below 2.0% long-run target, despite the huge monetary and fiscal stimulus injections during the period. Committee, however, noted that as the lockdown eases across the advanced economies, aggregate demand is expected to strengthen and inflation will pick up to support the expected output growth. Across the emerging markets and developing economies, the committee observed the divergent inflation trends, with most developing commodity exporting countries recording increase in inflation compared with other more diversified economies. This development had inadvertently exerted significant pressure on exchange rates of these economies as the pass-through to domestic prices has been amplified. The committee observed that the unprecedented increase in public spending to support households and businesses in the wake of the pandemic may spur inflationary pressure in some economies as the supply shortfalls struggle to meet up with the demand buildup. Domestic economic development. Available data from the National Bureau of Statistics showed that real gross domestic product (GDP) grew marginally by 1.87% in the first quarter of 2020, compared to 2.55% and 2.10% in the preceding and corresponding quarters of 2019. The performance was largely driven by 5.06% growth in the oil sector and 1.55% growth in the non-oil sector. The decline in output growth in the first quarter was largely attributed to the twin effects of the decline in oil prices and the shock from COVID-19 pandemic. Committee observed the gradual but persistent decline in the manufacturing and non-manufacturing purchasing managers indices below the benchmark. The manufacturing PMI declined to 41.1 index points in June 2020 from 42.4 index points in May 2020. Conversely, though, the non-manufacturing PMI improved to 35.5 index points in June 2020 from 25.3 index points in May 2020. The trend in the manufacturing and non-manufacturing PMI was attributed largely to slower growth in production levels, new domestic orders, employment rate, raw material supply, and new export orders. Committee noted the staff forecast of 1.03% contraction in growth during the second quarter of 2020 on the back of the continued adverse impact of the pandemic on the economy. The committee expressed concern over the persistent, albeit marginal, uptick in inflation for the 10th consecutive month as headline year-on-year inflation rose to 12.56% in June 2020 from 12.40% in May 2020. The increase in headline inflation was largely driven by the increase in both food and core inflation, which rose marginally to 15.18% and 10.13% in June 2020 from 15.04% and 10.12% in May 2020, respectively. Committee noted the contribution of the legacy structural factors in the persistent uptick in inflationary pressure. These factors included disruptions to key supply channels due to security challenges from herder-farmer clashes, banditry and kidnapping, inadequate transportation outlay, epileptic power supply, and low technological adaptability. These factors have compounded the supply chain challenges. Committee reiterated the need for a robust fiscal policy strategy to attract private investment and capital to finance the huge infrastructure deficit in Nigeria and strengthen the existing initiatives by the federal government and the CBN in this direction. Committee recognized the supportive developmental roles of the CBN towards addressing some of these structural issues. The MPC specifically expressed optimism on the future impact of the 50 billion naira household and SME facility, out of which 49.195 billion naira 2,000 beneficiaries. The 100 billion naira healthcare and 1 trillion naira manufacturing and agricultural interventions to support the rebound in growth from the impacts of the pandemic on the economy. The committee further recommended the CBN coordinated COVID private sector intervention scheme, which had mobilized over 32 billion naira to support the economy, lives, and livelihood. Committee noted that the CBN had disbursed over 152.9 billion naira to the manufacturing sector to finance 61 manufacturing projects and another 93.6 billion naira to the healthcare sector, amongst many other sector-specific facilities. The committee is hopeful that upon further drawdown of these intervention facilities, the much-needed reset and rebound of the Nigerian economy will become a reality. The committee noted that broad money supply M3 grew by 1.64% in June 2020 from 2.72% in May 2020, largely due to increases in net domestic assets, NDA, and net foreign assets, NFA. The growth in M3, however, remained well below the indicative benchmark of 13.09% for June 2020. Aggregate domestic demand net grew by 5.16% in June 2020, compared with 7.47% in May 2020. The committee commended the CBN loan-to-deposit ratio initiative to address the credit conundrum as the total gross credit increased by 3.33 trillion naira from 15.567 trillion as at May 2019 to 18.99 trillion naira at the end of June 2020. These credits were largely recorded in the manufacturing, consumer credit, general commerce, and information and communication, and agriculture, which are productive sectors of the Nigerian economy. Money market rates remained relatively stable in the review period, reflecting the prevailing liquidity situation in the banking system. The monthly weighted average interbank call and open buyback rates increased to 5.75 and 11.31% respectively in June 2020, from 5.22 and 5.80% respectively in May 2020. The committee welcomed the modest recovery recorded in the equities market as the all-share index and the market capitalization increased by 6.33 and 6.44% on April 30th and June 30th, 2020, respectively. The modest improvement reflected the resumption of business activities, which spurred market confidence as government commenced gradual ease of the lockdown. Committee noted the decrease in NPLs ratio to 6.4% at the end of June 2020 from 9.4% in the corresponding period of 2019 on account of increased recoveries, write-offs, and disposals. Committee expressed confidence in the stability of the banking system and urged the bank to monitor the compliance of deposit money banks to its prudential and regulatory measures to sustain the soundness and safety of the banking industry. In the light of the bank's continued efforts to find innovative ways of using local resources to diversify the sources of the country's foreign exchange reserves, the committee welcomed the decision of the Central Bank of Nigeria to develop a gold purchase framework under the federal government's Presidential Artisanal Gold Mining Development Initiative. The standardized gold bars, which will be purchased in Naira from Nigerian miners and refiners, would not only create thousands of jobs for the artisans, but to provide a new source of foreign exchange accretion to our reserves and ensure the strength and stability of our currency, the Naira. The committee also commended the federal government for the approval to establish a CBN-led infrastructure development company, which would leverage local and international funds for rebuilding of critical infrastructure across the country. This entity, which will be wholly focused on Nigeria and Nigerians alone, will be co-owned by the CBN, the African Finance Corporation, and the Nigerian Sovereign Wealth Investment Authority, but exclusively managed by an independent infrastructure fund manager that will mobilize local and foreign capital to support the federal government in building the transport infrastructure required to move agriculture and other products to processors, raw materials to factories, and finished goods to markets. The sum of 15 trillion naira is projected over 5 years for the initial run. The committee noted with satisfaction CBN's immediate work on the updates and timelines for the establishment of this much-needed entity. The outlook. The outlook for the global economy remains weak. The IMF's earlier expectations that the coronavirus pandemic will wane by the end of the second quarter of 2020 as economies implement the various prevention protocols were not achieved. Several countries witnessed a second outbreak after the initial ease in lockdowns. This necessitated the IMF's downgrade of output growth forecast for both 2020 and 2021. The slow recovery in oil prices and its attendant volatility is projected to continue in 2020 and well into 2021. This will further dampen recovery prospects, particularly for most oil exporting countries. With many central banks in the advanced economies exhausting their conventional monetary policy headroom, unconventional monetary policy tools will trigger global liquidity surfeit with consequences for many emerging markets and developing economies, including volatility in international financial systems and markets. Provisional data on key domestic macroeconomic variables indicate that the Nigerian economy may record negative quarterly GDP in the second quarter of 2020, but there is cautious optimism that the year may end in marginal negative territory with strong recovery prospects in 2021. The committee's consideration. The committee's considerations were guided by the developments in the global and domestic economic environment. The MPC noted that the current coordinated efforts by the federal government to contain the COVID-19 pandemic will reposition the economy on a sustainable path of rapid recovery. Committee welcomed the government's articulated fiscal stimulus to cushion the impact of the pandemic on the households and businesses through various palliatives and fiscal incentives, and reiterated the need for effective and timely implementation. The MPC expressed the utmost need for both the monetary and fiscal authorities to collaborate for the optimal synergy for measures targeted at reviving the economy. The committee called on the government to sustain its efforts at diversifying revenue sources and ensure fiscal prudence, particularly with the use of the recent grants and multilateral concessionary loans. The committee encouraged the adoption of counter-cyclical fiscal policy framework to shield the economy from persistent revenue shocks. The Monetary Policy Committee noted the bank's overarching commitment to maintaining price stability and encouraged the bank to sustain the current measures targeted at moderating inflation, including addressing some of the supply-side structural challenges. The committee urged the bank to continue to give particular attention to its mandate of exchange rate stability, given the recent volatility in the international financial system, to avoid excessive demand pressures in the foreign exchange market. The Monetary Policy Committee commended the bank on its efforts in sustaining the soundness and resilience of the financial system, particularly in the face of severe economic challenges. The committee noted the bank's drive to accelerate credit growth to the private sector, especially to micro, small, and medium-scale enterprises, and the recent monetary stimulus package to households and businesses affected by the pandemic. The committee's decision. The committee reviewed the policy options before it and argued that the option of tightening at this time will contradict the noble initiative of the expansion of affordable credit to the real sector, noting that this would heighten the cost of production, which will translate to higher prices of goods and services and harder economic conditions for our people. On the other hand, loosening monetary stance will provide the desired succor for stimulating output growth and rapid recovery, but with implications for domestic private investment and capital mobilization to support the huge domestic financing gap. Further cut in the monetary policy rate may not necessarily lead to a corresponding decrease in market interest rate, considering the current economic challenges. The committee was also mindful of the cut in policy rate at the last MPC meeting and the need to allow time for the transmission effect to permeate the economy. Given the plethora of monetary and fiscal measures recently deployed to address the impending economic crisis following the COVID-19 outbreak, it will be a relatively cautious option to hold in order to evaluate the effectiveness of these tools at addressing the current challenges, particularly with mounting uncertainties within the domestic economy, as well as the external vulnerabilities. After reviewing the three options, the Monetary Policy Committee noted that the imperative for monetary policy at the May 2020 meeting was to strike a balance between supporting the recovery of output growth and reducing unemployment while maintaining stable prices. Committee noted at this meeting that economic fundamentals have marginally improved by the end of June 2020, following the gradual pickup of economic activities as the positive impacts of the various interventions permeate into the economy. As a result, committee noted that the earlier downward adjustment of the monetary policy rate by 100 basis points to 12.5% to signal the loosening monetary policy stance is yielding positive impact as credit growth increased significantly in the economy. The committee also noted the positive impact of the various fiscal and monetary interventions on the household and SMEs and manufacturing sector. The committee also noted that increasing NPR at this stage will thus be counterintuitive and will result in upward pressure on market rates and cost of production. In view of the foregoing, the committee decided by a majority vote to retain the monetary policy rate at 12.5% and to hold all other parameters constant. The committee decided by a vote of 8 members to hold and 2 members voted to reduce NPR. All members voted to retain all other policy parameters. In summary, the MPC voted 1, to retain the NPR at 12.5%, 2, to retain the asymmetric corridor of plus 200 and minus 500 basis points around the NPR, 3, retain the CRR at 27.5%, and 4, retain the liquidity ratio at 30%. Thank you for your attention.
Thank you, Governor. Viewers, we have come to the question and answer session, but in consonance with the new normal, some of our pressmen have wired in some of their questions, and I have five questions from 3 pressmen here, and I will take those questions so that the governor can attempt to provide answers to them. I have 2 questions from Mr. Chima Obinna from This Day newspaper. The first question goes, there are fears that the COVID-19 pandemic has very adversely impacted banking systems across the world. How strong and sound is the Nigerian banking system today in the light of the massive economic and health challenges occasioned by the pandemic? The second question, he says, some of your critics have said that the forbearance you granted banks to restructure loans for their customers is like postponing the doomsday. What is your take on this? The second question comes from Ndoka Chejina of The Nation. 2 weeks ago, you started a currency adjustment. What should local and foreign investors expect from this exercise? Then Nancy Ilo Naji from AIT, Moneyline on AIT. You have made elaborate interventions to cushion the impact of COVID-19 on various sectors of the economy. Do you have any feedback as to the impact so far of these interventions? And lastly, last week, President Buhari launched the CBN gold buying project. How will this impact the way you manage Nigeria's external reserves? These are some of the questions coming from our colleagues. Mr. Governor, sir.
Well, thank you very much. On the first question, that tends to be asking questions about the soundness of the Nigerian banking system. Let me say that, and repeat myself, that the Nigerian banking system remains very strong and resilient. I must say that unlike in other climes, the Nigerian banking industry appears to be one of the well-regulated industries in the world today. We have prudential ratios that have been prescribed for the banks, and they are required to ensure that they abide by those prudential ratios. For instance, some of the very prominent ones are the non-performing loans ratio, the capital adequacy ratio, or the liquidity ratio. To demonstrate the fact that the Nigerian economy remains strong and resilient, as at May 2019, non-performing loans ratio in the industry was 11.1%. As at June 2020, NPLs have dropped to 6.41%. For capital adequacy ratio, which is a ratio that measures the size of capital that banks deploy into risk assets, as at June 2019, capital adequacy ratio was 15.2%. But as at June 2020, it had just remained flat at 15%. On liquidity ratio, by August 2019, liquidity ratio was 48%. But as at June 2020, liquidity ratio had dropped to 37%. Yes, liquidity ratio has dropped, and I will say understandably so. Because, for instance, you will note that from around July 2019 to June 2020, gross loans and advances advanced into the economy as a result of CBN's loans deposit ratio has increased by 3.33 trillion naira from 15.6 trillion in June 2019 to 18.9 trillion naira as at June 2020.